Welcome back to the deep dive. Today we are going to look at something that I can almost guarantee you don't think about when you wake up in the morning.
Oh, I would bet my own money on that.
Easily.
But, and this is the real kicker, if this specific piece of machinery we're discussing today stops working, if the gears grind to a halt, well, the global economy effectively freezes.
Yeah.
We aren't talking about the big banks themselves, not directly. We're talking about the invisible backbone that connects them all. We're talking about the plumbing.
And, to borrow a phrase, nobody ever cares about the plumbing until the toilet backs up.
Exactly. And when this toilet backs up, it doesn't just ruin your bathroom floor. It costs trillions of dollars and can, potentially collapse entire nations. We are diving into the world of central counterparties, or CCPs.
It sounds incredibly dry, doesn't it? Central counterparties. It sounds like something you'd read in, a terms and service update that you immediately ignore. It really does. But as we went through this stack of research, and we have a lot today, papers from the Federal Reserve Board, the Chicago Fed, technical documents from Murex, and some really dense academic studies, it became clear that this is actually one of the most high-stakes, high-wire acts in modern finance.
It absolutely is. And our mission for this deep dive is to answer a pretty terrifying question that just kept popping up in all the data. For the last 15 years, really since the 2008 financial crisis, we've completely rewired the global financial system to fix one specific problem: credit risk.
We wanted to make sure that if one bank failed, it wouldn't just drag everyone else down with it. We wanted to build financial firewall.
Precisely. That was the goal. But the question the data is asking now is, by fixing that credit problem, did we inadvertently create a massive liquidity bomb?
A liquidity bomb.
Yeah. Did we build a system that acts like a giant vacuum cleaner, sucking all the cash out of the economy at the exact moment we need it most?
That is the trade-off we are looking at. Safety versus liquidity. So, okay, let's unpack this. We need to start by understanding the shift, because the world looked very, very different before 2008. If you were trading derivatives, say, in 2007, what did that map even look like?
It looked like a mess. I mean, that's the simplest way to put it. If you try to visualize the financial market back then, especially the OTC, the over-the-counter derivatives market, it was just this massive tangled spider web.
And the technical term for that is bilateral trading. Right?
Bilateral. Two sides. Simple enough on the surface. Bank A does a trade with Bank B. Bank B then trades with Hedge Fund C. Hedge Fund C might trade back with Bank A. Everyone has all these individual private contracts with everyone else.
And the big problem with a spider web is that it's opaque. You can only see the strands you're touching.
Completely. If I'm Bank A, I know exactly how much money Bank B owes me. That's my exposure.
Yeah.
But I have zero idea how much money Bank B owes to Hedge Fund C or to anyone else. I can't see their other liabilities.
This is the Lehman Brothers problem in a nutshell.
It is exactly the Lehman problem. When Lehman went down, nobody knew who was exposed to whom. And it created this panic because, Bank A didn't know if Bank B was about to die because Bank B was owed a ton of money by Lehman. It was a chain reaction of total ignorance.
So the global regulators, the G20 leaders, they get together in Pittsburgh in 2009. The crisis is still smoldering, and they say never again.
Right. They mandate a shift, a massive shift to central clearing. They basically said, we are going to take this messy spider web and we're going to turn it into a hub and spoke model.
And the data on this shift is just staggering. I was looking at one of the Fed papers in our packet, and the adoption chart isn't a curve. It's a hockey stick. It just goes straight up.
Oh, it's a total regime change.
Yeah.
I mean, think about this. In 2007, less than 25% of interest rate swaps, which are a huge, huge chunk of the market, were centrally cleared.
Okay.
By 2018, that number was over 75%. And for some of the really standard asset classes, it's basically 100% now.
So we moved everyone into this new system. But I want to pause here and get really specific. What does that actually mean? If I'm a bank and I make a trade and it gets cleared, what physically or I guess legally happens to that contract?
This is where we get to the magic trick. And it really is a kind of legal sleight of hand. It's a concept called novation.
Novation. Okay, define that for us.
So let's say you and I do a trade. You're selling me a bundle of derivatives. I'm buying them. In the old world, the bilateral world, we have a contract directly with each other. If I don't pay you, you sue me.
Simple enough.
Right. In the new world, we send that trade to the central counterparty, the CCP. The moment they accept that trade, a legal guillotine comes down.
A guillotine.
A guillotine, our original contract. It ceases to exist. It is completely extinguished. Poof, it's gone.
Okay, so we have no contract. That seems Worse.
Well, it is immediately replaced by two new contracts. Contract number one, the CCP buys from you. Contract number two, the CCP sells to me.
So we don't know each other anymore in the eyes of the law?
Legally, you and I are total strangers. You are dealing only with the CCP. I am dealing only with the CCP. The CCP becomes, and this is the famous phrase you see in all the regulatory text, the buyer to every seller and the seller to every buyer.
That's the hub in the hub and spoke model.
That is the hub. And the beauty of this, the reason regulators love it so much, is that you no longer have to worry if I'm going to go bankrupt.
Right.
You don't care about my credit score. You don't care if I'm over-leveraged on some other trade. You only care about the health of the CCP. It standardizes the risk into one big, strong entity.
It simplifies the web. Instead of worrying about 1,000 different trading partners, I just have to worry about this one giant fortress.
Precisely. And, there is a nuance here depending on where you are in the world. In some jurisdictions, they use something called an open offer system, where the CCP is involved from the very moment the trade is struck, while others use novation, where the contract is replaced after the fact.
But effectively, the end result is the same.
The result is identical. The CCP is the principal to every single trade. They are the firewall.
Okay, so that's the legal structure. It's a huge change. But there's another benefit, right? It's not just about simplicity or hiding the counterparties. It's about the math. We need to talk about netting.
Oh, netting is the superpower. It is the economic engine that makes the entire CCP model viable. Without netting, honestly, the capital requirements would be completely impossible.
The sources gave a really good example of this, almost like a dinner party debt situation. But let's walk through it slowly, because I think the arithmetic here is where the light bulb really goes on for people.
Absolutely. Let's visualize it. Imagine there are 4 banks in a market, A, B, C, and D. And they're all trading with each other in a perfect circle.
Okay.
So Bank A owes Bank B 100 million. Bank B owes Bank C 100 million. Bank C owes Bank D 100 million. And to close the loop, Bank D owes Bank A 100 million.
So everyone owes someone 100 million. In a bilateral world, without a CCP, that's $400 million of debt floating around the table.
Correct. That is $400 million of what we call gross credit exposure. And if you are a risk manager at Bank B, you have to hold capital against that 100 million that's coming from A, because A might default. Everyone is holding capital. Everyone is stressed.
But if you put a CCC in the middle of that circle,
the hub steps in. The CCP looks at the entire table and says, wait a minute, Bank A, you owe 100 million to B, but look here, you are also owed 100 million from D.
So my net position is 0. I'm flat.
Exactly.
Okay.
The CCP calculates the net difference. In this perfect circle scenario, the CCP says nobody owes anything. The total exposure in the system is 0.
And it does that for everyone at the table.
Yes. In that perfect scenario, the total exposure drops from 400 million down to nothing. The CCP essentially just cancels out all the offsetting debts. This is what we call multilateral netting.
Which frees up a massive amount of capital for the banks. Instead of holding cash in a vault against that 400 million of potential loss, they can use that money for other things, for lending, for investing.
It's massively efficient. The ARCS paper we looked at, it ran a simulation on this very thing. They found that in a typical market scenario, just moving to a CCP reduced the total exposure in the system by almost half compared to bilateral trading.
Wow.
That is billions, maybe trillions of dollars of capital unlocked across the system.
And you knew there was a but coming.
There's always a catch in finance, isn't there?
Always.
Yeah.
The ARCS paper also pointed out this weird paradox. Netting is fantastic within a CCP. But what happens when you have multiple CCPs? Because we don't just have one global clearinghouse for everything, do we?
No, we absolutely don't. And this is what some have called the asset class trap. It's actually a debate that's been raging in academia for a while, specifically between researchers like Duffy and Zhu on one side and Kant and Kalkulm on the other.
Okay, break that down for us. What is the trap?
Okay, so netting works because you can offset your winners against your losers, right?
Right.
But what if your winner is in New York at the DTCC, which clears stocks, and your loser is in London at LCH, which clears interest rate swaps?
2 different clearinghouses, 2 different fortresses.
Right. The clearinghouse in New York doesn't know, and legally, it can't care about your loss over in London. They can't net those positions against each other.
So in the old bilateral world, if you and I were just 2 banks trading directly, we could net everything we did together. Stocks, bonds, swaps, you name it. We had what was called bilateral netting across all asset classes.
Exactly. If we had a master agreement, we could net my stock debt against your swap debt. But by moving to these specialized CCPs, one for swaps, one for energy futures, one for stocks, we broke the ability to net across those silos.
So, Wait a minute. By splitting the market into these specialized hubs, we might have actually increased the total amount of collateral locked up in the system in some cases.
That was the fear. That was the argument from Duffy and Zhu, exactly that we were fragmenting the netting pools. They suggested that if you split the liquidity too much, you actually lose the efficiency you were trying to gain.
So did it turn out to be true? Is the system less efficient now?
Well, the other paper, the Conant-Cockholm paper, it argues that actually central clearing still wins out in the end.
Why? What did they find?
Because of riskiness and correlation. They found that different asset classes, like, say, credit derivatives versus interest rates, they often don't move in perfect sync anyway. So the benefit you were getting from that cross-asset bilateral netting wasn't as huge as the massive benefit you get from multilateral netting within the big, heavy asset classes like swaps.
Okay, so it's a net positive, but maybe not a perfect one.
Exactly. Net-net, the CCP model is likely still more efficient. But it's not as efficient as it could be if there was just one giant CCP for the entire planet.
Which would be a monopoly of absolutely terrifying proportions.
Precisely. So you have to pick your poison. A fragmented system with some small inefficiencies, or a single point of failure for the entire global economy.
Okay, so the math generally works out. We've established that CCPs are efficient, they simplify the web, but now we have to talk about the elephant in the room.
The risk.
If the CCP takes on everyone's risk, if it stands in the middle of every single trade, what happens if one of its members actually goes bust? If a big bank fails, the CCP is left holding a very, very big bag.
And this is where we get into the default waterfall.
It sounds like a ride at a water park, but I have a feeling it's much less fun.
Much, much less fun. The waterfall is the defense system. It's the series of firewalls that have to burn through layer by layer before the CCP itself can collapse.
Okay, let's walk through the layers. Layer 1, what's the first line of defense?
Layer 1 is always the defaulter's own money. This is what we call margin.
Right. We hear about margin calls all the time in movies. Usually it involves people shouting into telephones.
Wow.
But there are two distinct types, right? And the distinction is really vital here.
It is absolutely vital. There's variation margin, or VM, and there's initial margin, or IM.
Okay, VM first. What is that?
Variation margin is the daily and sometimes even hourly settling of accounts. It's mark to market. If you bought a portfolio of derivatives and it dropped in value by $10 million today, you owe the CCP $10 million today in cash. On the barrelhead?
Just to keep the scoreboard at zero at all times.
Exactly. The CCP never, ever lets debt build up. If you can't pay that VM, you're in default immediately. Game over.
Okay, so that handles the daily profit and loss. What is initial margin then?
Initial margin is the security deposit. It's the just-in-case fund. The CCP runs a calculation. It says, okay, if this bank goes bust right now, it'll probably take us, say, 3 to 5 days to close out all of their positions in an orderly way.
Right.
So how much can a market realistically move against us in those 5 days?
They're trying to predict the future.
They're modeling risk. They use complex models like value at risk, or VR, or more recently, expected shortfall, and they usually model it to the 99th percentile. They want enough cash from that member sitting there in advance to cover the worst case scenario over those few days while they clean up the mess.
So a member, let's call it Bank X, fails. The CCP immediately seizes Bank X's variation margin and initial margin to pay off its debts. But what if that's not enough? What if the market moves more than the 99th percentile? What if it's a 100-year storm?
Then you crash through to layer 2 of the waterfall, the default fund.
This is the mutualized pain part.
This is where it gets a little socialist, you could say. Every single member of the clearinghouse has to contribute to a shared pot of money. It's a communal insurance fund. If Bank X's margin isn't enough to cover its losses, the CCP dips into this communal pot.
So Bank Y and Bank Z are now paying for Bank X's mistakes.
To a degree, yes. But before they drain the neighbors' pockets, there is usually another very important sublayer. It's called the skin in the game layer.
Right. I saw this in the Eurex documents and the model risk papers. This is where the CCP has to put its own capital into the waterfall.
And this is absolutely crucial for incentives. If the CCP is just playing with other people's money, what stops them from getting lazy with their risk models? They might set margin too low just to attract more business.
Sure.
But if the first few $1 million of loss come out of the CCP's own equity, out of their shareholders' money, they tend to be a lot more careful.
The model risk paper actually proved this, didn't it? It showed that higher skin in the game correlated with better, more conservative risk modeling.
It did. It's the most basic rule of finance. Don't trust anyone who doesn't have something to lose themselves.
Okay, so we've burned through the defaulter's margin. We've burned through the CCP's own skin in the game. We've even burned through the entire default fund, and the hole is still there. What happens at the very bottom of the waterfall?
The assessment powers.
That just sounds ominous.
It is. The CCP has the legal right, written into the membership agreement, to turn to the surviving banks, the ones who did nothing wrong, and say, we need more cash now.
They can just demand a check. Just like that.
Yes. It's usually capped maybe to 1 or 2 times their original default fund contribution, but we are talking about hundreds of millions of dollars. These are called unfunded commitments. The banks don't have this money sitting at the CCP, but they're legally obligated to send it if they get the call.
And this brings us right to the core conflict of this entire deep dive, the central paradox.
The credit versus liquidity paradox.
Let's unpack this carefully. We built CCPs to stop credit risk, the fear that the person on the other side of your trade won't pay you.
And to be fair, they do that very, very well.
But the Federal Reserve Board paper argues that by solving that problem, we massively increase liquidity risk, the need for cold, hard cash right now.
Think about it. In a real crisis, what happens? Prices go crazy. Markets are swinging all over the place. Volatility spikes.
Right, the VIX index, the fear gauge, it shoots up. Everyone panics.
And remember how initial margin is calculated. It's based on models that feed on volatility. If volatility doubles, the CCP's computer models wake up and say, the market is suddenly twice as dangerous. We need twice as much protection. Double the margin for everyone.
So at the exact moment when the market is crashing and banks are terrified and hoarding every dollar of cash they have, the CCP sends them a bill demanding they hand over billions of dollars in fresh cash.
The academic papers call this post-cyclicality. I prefer your vacuum cleaner analogy. The CCP acts like a giant automated vacuum, sucking liquidity out of the banking system right at the moment the system is most fragile and dehydrated.
And this isn't just a theory, this has actually happened.
Oh, it has. I mean, the 1987 crash was a huge wake-up call on this. Ben Bernanke wrote about this way back in 1990. But let's look at something more recent. Brexit. June of 2016.
The referendum vote happens. The British pound crashes against the dollar. It was a massive, unexpected shock to the system.
And the margin calls were instant, and they were massive. The data shows this huge spike in variation margin calls that was just off the charts. Banks had to come up with billions of dollars overnight to cover the moves in the currency markets.
But they handled it. The system bent, but didn't break.
They did. They handled it. But let's look at an even more telling case. The NASDAQ clearing default in 2018. This is a fascinating story because it wasn't a big bank that failed. It was a single trader, a guy named Einar S.
The classic rogue trader scenario.
He wasn't even really rogue, which is the scary part. He just made a really, really bad bet. He was a private trader in Norway, very successful for a long time. And his big trade was betting on the spread between Nordic power prices and German power prices.
And what was the logic of that trade?
He thought the gap between them would close. He thought the prices would converge. But then it rained.
It rained.
It rained a lot, very heavily in the Nordics, which are full of hydroelectric dams. So lots of rain and lots of cheap hydropower, driving Nordic prices way down. Yep. At the exact same time, carbon prices spiked in Germany, which relies more on fossil fuels, driving German power prices way up.
So the spread didn't close. It ripped apart.
It widened massively.
Yeah.
And it happened incredibly fast. His portfolio just plummeted in value. The CCP NASDAQ clearing issued a huge margin call. He couldn't pay it. Default.
So they go to the waterfall.
Right down the line. They took all of his margin. Gone. It wasn't nearly enough. The loss was much bigger than his deposit. So they cut through the CCP's own skin in the game. Still not enough.
So they had to hit the default fund, the mutualized pot.
They did. They had to ask the other members who had nothing to do with Nordic power trades, mind you, these are big European banks, to replenish the fund. The surviving members had to collectively cough up about 107 million euros within a couple of business days.
That's the survivor pay model in action. Frighteningly real.
And that was just one trader in a relatively niche commodity market. The shockwaves were contained. But imagine if that was a G-SIB. Imagine if that was JP Morgan or Deutsche Bank failing. The numbers would be astronomical.
And that leads perfectly into the concentration issue. The Chicago Fed paper had some really eye-opening data on who actually makes up this whole ecosystem.
It's a very, very small club. We call it the clearing ecosystem, but it's really more of an oligopoly.
You have the hubs, the CCPs themselves, and there are only a few really big ones that matter globally: CME, IC, LCH, DTCC.
And then you have the spokes of the clearing members. These are the big banks that are allowed to connect and trade directly with the hub.
And that list has been shrinking for years.
Drastically. Since 2007, the number of futures commission merchants, or FCMs, that's the regulatory term for these clearing members, has dropped significantly. But the amount of client money they hold has skyrocketed.
So fewer banks are holding more of the money and the risk.
And it's the same handful of banks that are the biggest, most important members connected to every major CCP. The Chicago Fed calls them the G-SIBs, the global systemically important banks.
If you have Bank of America, Citi, JP Morgan, Barclays, they are the biggest members at CME, and they're also the biggest members at ICE and also at LCH.
This is the interconnection problem. This is the nightmare scenario. If a G-SIB fails, it doesn't just default at one CCP. It defaults everywhere simultaneously.
It's a synchronized shock across the entire system.
Exactly. I mean, just try to game this out. A major bank goes down. CME immediately calls for cash. ICE calls for cash. LCH calls for cash. They're all trying to liquidate the same massive portfolio of the same failed bank at the same time.
A global fire sale.
A global fire sale. And who are they trying to sell these assets to?
The other banks, the survivors.
The other banks, who are also the biggest members of all those CCPs and who are also getting hit with assessment calls from all sides to refill the default funds.
So the survivors are getting hit from both sides. They're being asked to buy the toxic assets of the dead bank while simultaneously having their own cash sucked out to refill the insurance pot.
This is why the liquidity risk is so terrifying. It's not that the system doesn't have enough capital in the long run to absorb the loss. It's that it might not have enough cash, enough liquidity in the short run in that 1 hour window to meet the call.
1 hour. You mentioned that earlier. Is it really that fast?
Yes. The Fed board paper specifically notes that intraday margin calls often have to be met within 1 hour.
So let me get this straight. A bank can be completely solvent. It has plenty of buildings and long-term bonds, but if it can't physically wire $1 billion in cash in under 60 minutes...
It defaults. Technically, yes, it defaults. And that could trigger a domino effect that has absolutely nothing to do with long-term solvency and everything to do with short-term plumbing.
This makes the auction process sound like an absolute nightmare. I read about this in the Eurex documents. When a member defaults, the CCP tries to auction off their portfolio to the other members.
Right. They don't just dump it on the open market immediately because that would crash prices for everyone. They try to find a volunteer to take over the dead bank's position. Who wants this giant portfolio of interest rate swaps?
But if the market is crashing, nobody wants it. It's toxic.
Exactly. Who wants to catch a falling knife? So the CCPs have developed, let's say, some very strong incentives. They use a lot of sticks and not many carrots.
Juniorization. That was a term that really stuck out to me. It sounds like something that happens in corporate management, but here it implies a kind of punishment.
It's a brutal mechanism. Basically, the CCP says to the surviving members, you have to bid competitively in this auction for the dead bank's portfolio. If you don't, we're going to use your portion of the default fund first to cover the losses.
So it's help us fix this mess or we take your insurance money first.
Essentially, it's a way to force the banks to be the buyers of last resort.
It seems like a very elegant, very robust system, as long as it's only one member failing at a time.
That's the absolute key. The system is designed for what they call cover one or cover two. That means the CCPs have enough pre-funded resources to survive the default of their single largest member, or maybe their two largest members.
But in a truly systemic crisis like 2008, do banks fail one at a time, nice and orderly?
No. They tend to fail in clusters. They fall together.
Let's just step back for a second. We've painted a pretty intense high-stakes picture here, but it's worth noting that this idea of a clearinghouse isn't new. It's not some crazy invention of 21st century algorithms and high-frequency trading.
No, not at all. The history here is surprisingly deep. I was reading the notes on the history of clearing, and there was a proposal for a clearinghouse as far back as 1636.
Philip Berlamacci, is that right?
That's the one. He was a financier to King Charles I. It didn't happen back then, but the concept, the core idea, was there.
But it really started in the coffee houses, right? With checks.
The London check clearing in the 1700s, this is my favorite part of the whole history. You had these bank clerks, they were called walk clerks, and their job was to walk all over the city of London, going from bank to bank to exchange checks for gold. Here's a check drawn on your bank, give me the gold.
Which sounds incredibly inefficient and dangerous. You're just walking around 18th century London with bags of gold.
Right, you're a walking target.
Yeah.
So the clerks, being smart and maybe just a little bit lazy, decided, hey, instead of all of us walking to every single bank, let's just all meet in one room.
Makes sense.
They rented a room in a coffee house. They'd all sit down, trade all the checks they had for each other, tally up the net difference at the end of the day, and only settle that final balance.
That is the first clearinghouse.
That is the direct ancestor of the modern CCP. And then eventually the stock exchanges adopted it. Frankfurt in 1867, London in 1874.
And what about the U.S.?
The U.S. was a little slower on the uptake. The Philadelphia Stock Exchange did it in 1870, but the New York Stock Exchange, the big one, actually held out until 1892.
Why? Why would you resist something that is so obviously more efficient?
They were worried about transparency. It's amazing. Some of the big, powerful brokers liked the secrecy of the old bilateral system. They didn't want a central entity knowing all of their positions.
Yeah.
You know, information is power, and they didn't want to give it up.
That sounds very familiar.
History certainly rhymes. But the study from 2019 on that 1892 shift is really telling. They found that when the NYSE finally did adopt a clearinghouse, market volatility dropped substantially. The whole market just became more stable.
Because people finally knew that the trades would actually settle. The counterparty risk was gone.
Exactly. The core benefit of clearing has always been stability and certainty. I know I will get paid.
And that brings us right back to today. We have maximized that certainty. We have built this incredible system where I am 99.99% sure I will get paid on a trade because this giant CCP is guaranteeing it.
We traded that messy web of credit risk for certainty.
But the cost of that certainty is this massive pro-cyclical liquidity engine. We have concentrated all the risk into these few too-big-to-fail nodes.
That is the fundamental trade-off. We cleaned up the web. We made it transparent. We made it incredibly efficient with netting.
Yeah.
But we created these single points of failure. And if CCP fails...
It's game over. There's no backstop.
Well, there is no backstop for the backstop.
Yeah.
Except, of course, the central banks.
Which implies that ultimately the taxpayer is the backstop for the CCP.
Implicitly, yes. If a CCP burns through the entire waterfall, through all the assessments, and is still insolvent, the Federal Reserve or the European Central Bank, it effectively has to step in. Because you simply cannot let the global plumbing burst.
So what does this all mean for the listener? Why should they care about the intricate details of the market's piping?
I think it means understanding that the safety of the financial system has changed shape. It's not about checking if your local bank is solvent anymore. Not really. It's about understanding that the system as a whole is tighter, faster, and more demanding of cash than it has ever been before.
That's a high-pressure system.
It is. It's a very high-pressure pipe. And high-pressure pipes are great at moving things very quickly and efficiently. But when they burst, they don't just leak. They explode.
That is a very cheerful thought to end on.
Always here to brighten your day.
But it's fascinating. We didn't eliminate the risk. We just moved it. We changed its name from credit to liquidity.
And we concentrated it geographically and institutionally into a few buildings in New York, Chicago, and London.
So here's the final thought I want to leave you with. We talked about the waterfall, and we talked about those assessments where the CCP can turn to the surviving banks and demand more money.
Right. The unfunded commitments.
Think about the circle here. The CCPs rely on the banks for liquidity. They need the banks to be able to pay the margin calls and the assessments. But the banks rely on the CCPs for safety to guarantee that their trades are good.
It's a symbiotic relationship for sure.
Or is it a circular dependency? A doom loop. If the banks are in trouble, they can't pay the CCP. If they can't pay the CCP is in trouble. And if the CCP is in trouble, then all the banks are in trouble.
It's the snake eating its own tail.
In the next massive global crisis, does that firewall we built actually hold? Or does the fact that everyone is connected to the same hub mean that instead of building a fire break, we actually built a bridge for the fire to cross everywhere all at once?
That is the multi-trillion-dollar question.
And on that note, we will let you get back to your day, hopefully looking at the plumbing of the world with a little more respect and maybe just a little more fear.
Just a little.
Thanks for listening to The Deep Dive. We'll catch you next time.